Hey, best ever listeners. Welcome back to the best ever CRE show. This is Invest Beyond Multifamily. I'm Amanda Cruz, joined as always with Ash Patel. What's going on, Ash?
Hey, Amanda, we actually are booking our best ever flights. Have you booked yours yet?
Oh,
For the
crap.
best ever
No, I got to
conference?
get on that. I'll be there, of course, at the
Yeah.
conference in February.
Yeah. So, hey, best ever listeners, you guys, if you've gone to our conference, you know it's incredible. If you've never gone, it is the best networking. Go to besteverconference.com. Use the code podcast10, capital P, or is it all caps?
All caps.
All caps, podcast10, get 10% off your ticket. And come say hi to Amanda and I when we're there. We're very accessible. We're literally just there all the time. So please check out that conference.
Heck yeah. And we'd love to interview you. If you have commercial experience, if you've done one deal or 100 deals, come on the show. Tell us about it. Go to Best Ever CRE and go to podcast, sign up. We'd love to have you on.
Amanda, our guest today is Scott Lurie. What'd you think of this podcast?
Dude, listen to the entire conversation. Make sure you don't even listen to the first 10 minutes. He just delivers bombs throughout the entire thing. He's had 20 or 30 years of investing experience and really approached it from discipline, not from early success. And there were tons of just life lessons about the length of a career in commercial real estate. Very impressive. How about you, Ash?
He was just a straight shooter. You know, we try to knock holes in people's stories. He's legit, man. He started one of those I Buy Ugly Houses franchises up to $700 million in assets under management and is just a straight hustler. The guy just works, hustles, and gets things done. No secret to his success, man. But a great, great conversation today.
Heck yeah. Let's jump into it.
Let's go.
Scott Lurie, welcome to the Best Ever CRE show. How are you doing today?
Doing great. It's great to be with you today.
Hey, we're looking forward to this conversation. You have a ton of experience in commercial real estate, and we can't wait to dive into it. Can you start by giving the Best Ever listeners a little bit about your background and what you focus on now?
Yeah, sure. So my background's a brief story. I graduated with a finance degree from the George Washington University, and I wanted to potentially get into investment banking or private equity, and ultimately made my way back to Milwaukee, Wisconsin, where I was the first franchisee for the We Buy Ugly Houses homevestors. So no experience in real estate. I was previously working for a family business that was not satisfying me personally and professionally. And so left that business without any experience in real estate and jumped right into a franchise for the We Buy Ugly Houses in southeastern Wisconsin, Milwaukee area, and started buying, fixing, flipping, wholesaling real estate. And started in 2003, August of 2003, and picked up my first rental about 2 years later in 2005, and built up a material portfolio of single family duplexes and multifamily units, about 1,500 of those units during that course of my tenure. I left Home Investors in 2008. They became insolvent and the world was kind of, I think, crashing. I'm not sure. I was busy buying real estate. And subsequent to that, ended up becoming a hard money lender in 2009, created the Milwaukee Hard Money, which today is the Hard Money Co., where we continue to lend today, as well as I've matured my portfolio, and we buy and build multifamily and industrial assets throughout the country, and continue to expand our portfolio every quarter. Today, we have about $710 million of asset under management.
You were back buying and flipping houses at the start of the Great Recession, and you didn't notice that the world was crumbling because you were still buying assets?
Yeah. I always tell people I learned a lot about the crash that occurred in 08, 09, and then subsequently the pieces falling back together in 2010 moving forward. And, I watched it happen. I was conscious and aware of what was happening, which was this bizarre disposition out of the mortgage industry where they wanted to lend money, overinflated homes to people that couldn't afford them. It was kind of like a weird recipe, right? You were like, well, when is this going to work? And probably never. But you kept going. And I had rental units at the time. I had about 600 rental units at the time. I paid my bills every month. I kind of was nose down buying assets and kind of was watching what was going on, but kind of knew that the people that were using that as their convenient excuse to exit the real estate industry were really taken for in a bad way, because for us, it really was a buying opportunity. There was distressed debt. Following the great 2008, 2009 mess, in 2010, January of 2010, we bought our largest amount of assets in one day. We bought 410 doors in one day out of a federal bankruptcy court. And I was like, man, this is the greatest thing that's ever happened. We paid $9,000 a door for 410 units. I felt like I just won the lottery for our world. And, but yes, kind of nose down, watched it all unfold. Never missed a payment, never missed a beat. So I struggle with that being a convenient excuse for a lot of my peers at the time of, oh yeah, the great blow up. I'm like, well, what did you do? Did you stop working? Did you stop collecting rent? Did you stop? No, they over leveraged and didn't want to pay. Kind of a bad recipe. So certainly we survived and prevailed with great outcomes during that disaster.
Scott, you were not over leveraged. Did you also have a giant piggy bank?
No. So it's a great question. No. So some people love to dig into this, and I think it's a really fascinating life lesson, right? So we had 600 doors at the time. All of our 600 tenants paid rent, right? We collected rents. We weren't refinancing. We weren't over levering. I didn't need to take out money to go buy something that had a depreciating value, like a car or something silly like that. All of our tenants paid. We paid all of our mortgage payments, and we had cash flow. We were cash flowing. So what really happened, if you go break down what happened in terms of that disaster, was over leverage that was allowed, permissible over leverage, lack of discipline, and then just basically people that were buying houses, right? Fix and flippers were selling houses that were worth, I had one house, true story, that I paid $5,000 for. I sold it on a wholesale for $35,000. That person got a loan for $140,000. They sold it for $240,000, and it was offered back to me at the end of that whole iteration for $10,000. And I said, no, I don't want it back. So it was a property that I remember was falling apart. I couldn't believe someone wanted to pay $35,000 for it, let alone get $240,000 in debt on it. But that really happened, and that was a perfect storm of how you lose $230,000.
That was some amazing discipline when a bank will give you 110% of the value of some bullshit appraised value too, not even a real value. Right. And you didn't take it.
Yeah, I think that's right, Ash. I think if you think about it, I was in this for the long game, right? I set myself up to be here forever, not to enjoy the fruits of some credit or some debt that I could take out and then have a plausible excuse. That really doesn't work, right? And so all of those lenders that lent to me and I was borrowing from in 2008 and could have done some damage, they're still my lenders today. I've got great relationships with most of those parties that haven't retired or left the industry. And we remain disciplined, right? Our core values are discipline, real estate, despite what you might see late night, when it was on late night television, is a get rich quick scheme. It's a long marathon that at the end of your 26.2 miles, you have a nice prize. You've got generational wealth. You've got the ability to keep moving forward, and you have depreciation and don't have to pay tax. That was enough. That was enough at the end of the day. I didn't need to be greedy and do the last piece of the hammer, which was pull out all this money and then do what with it? Nothing. I was disciplined.
You didn't take all those refinances. You didn't take all that extra money. So how did you keep coming up with the cash to buy more properties?
Amanda, great question. We're a syndicator, right? So I've been syndicating before I knew what syndication was, right? I was a pass the hat, let me make sure everyone gets taken care of kind of guy. That's how I got started. I had no money, but I knew that I could always do well. It goes back to the days when I would buy t-shirts, or I used to buy discounted tickets and sell them for retail value, and you have to come up with money. We're syndicators. We would syndicate, and we syndicate today all of our transactions, which simply means that we make an offering through an offering memorandum, through a Form D or a 506C, which is part of the SEC's offerings. We make these offerings to the public, to the general public. and people choose to make investments with us based on the investment thesis. And, our track record and background and history remains flawless, and we're proud of that. And we continue to grow through that process, right? So we continue to add new investors every day into what we're doing. We keep engaging with our existing investors to get them to consider an additional investment with us. And obviously, our results are what get them to do more investing with us. And
are you mostly focused on development these days, or are you also doing value add still?
So in the multifamily sector, we're only doing development right now. It's getting harder, right? You hear the cost of living has gone up. It's not us that has created the cost of living to go up, right? It's the overall sheer cost to build has gone up. It's gone up. What used to be $100,000 a door, that was $140 a door, that was $180 a door, is now $220 a door, and so on. So it's hard finding the deals that are value add opportunities. It's just not something we do a lot of. We did do a lot of it, and then a lot of people jumped into the space and it got really overpopulated. People were, what we felt good buying for 40, someone was buying for 70 a door. I don't know how that shakes out, right? Because you still have to go through the process. We do buy a lot of value add in the industrial space all over the country. So we're adding probably $100 to $200 million of assets each year in that category, which is what we find to be very attractive to us. And our investor syndication pool really clamors to that concept, which is value add, upside, current cash flow, and depreciation. And so we can give them all of that in a tight box of an investment, and they really enjoy those types of investments.
All right, what's that buy box?
Just to your point, it didn't work out for a lot of people in multifamily when they bought those 3.5 cap properties. And as soon as rates went up, you get to see who's swimming naked.
Yeah, right. My bad. I totally forgot, Ash, to give you a minute to crap on multifamily.
Multifamily.
Darn it.
Go ahead, Amanda.
All right, what's your buy box, Scott? You're buying all over the country, value add industrial. What are you actually buying?
Great question. So we buy mostly what I would call B industrial, so legacy industrial that has something on it, right? So either it's in the middle of or about to be in lease negotiations for an extension. We see markets where there can be 20 to 30% value add upside at lease maturity or below market rent. So if rents are below market by 20 to 30%, we're buying. If their lease is coming off and we have an opportunity to renew existing tenant for a 20 to 30% increase, that happens. That's a buy box. Our buy box is where a lease is existing at modified gross, which simply means that the expenses of the building are not 100% borne by the tenant. And that maturity allows us to make it a triple net deal where all of the expenses, traditionally except roof and structure, become that liability of the tenant. We look at that as an upside where you can pick up 40 to 60 cents sometimes in operating expenses that landlord has been accustomed to paying that we can pass on to tenants. And then we look at markets that have, generally low vacancy. And so we look at those low vacancy markets that are not rising in vacancy or that have not a lot of new starts that'll create a lot of pending vacancies. And all of this data, we're a data firm at the end of the day, just like everyone else. All this data is so readily available that you should not be buying a 3.5 cap and thinking it's going to work, because the math doesn't work. So you shouldn't do that. And so if you look at the buy box that we're in, we're pretty disciplined. It takes a lot of hunting, right? And every day you go fishing, you don't catch a fish. You're fishing. You're in the process of doing something. And so we go hunting and fishing each day to try to find assets that work. Sometimes the deals that we offer today become the deal for 2026 or 27, just because that's how the evolution or how the deal cycle actually plays out.
Scott, would you buy vacant industrial?
Absolutely. Absolutely. And we do. We just bought a former printing facility that had about 500,000 square feet, all vacant. And it was a value proposition, Ash. What the proposition was is we paid $12 a foot for the assets. And so our proposition was, if we can lease these at modified gross, even at $2.50 a foot or $3 a foot, we're in the win. We've already signed 3 leases for that building right now. So within the first 60 days, we already have revenue covering all of our obligations, and we're moving forward to release the rest of the space. So yes, you have to be careful in vacant industrial, right? You have to be mindful of what that means and the obligations you're creating. And when we buy vacant industrial, our pro forma has a pretty large interest reserve that allows us to get through what would be the choppy cycle or the vacancy cycle.
Now, you talked about being very disciplined. What do you do when you're looking at a vacant building? Do you test market it? How do you know it's going to work?
Well, you don't. If you knew it was going to work, it wouldn't be investing. It'd be, I don't know what you'd call it. It's the same thing with, all of the various different iterations of life. But we try to put ourselves in the best possible position for success. And that doesn't guarantee success, but it mitigates the risk, right? It reduces the potential downfall. So if we're in a market that we have so much concern over, we could get into the market. We ask the brokers, how long will it take to lease this? What's the lease risk? And sometimes they say it's going to be 2 years, and then we don't put in 12 months of interest reserve because that would be silly, right? They're telling you it's 24 months and you put in 12 months, you're kind of not really listening. So we would put in 24 months of interest reserve. And if we do it in 8 months or if we do it in 14 months, we're ahead of schedule. And so we listen, we evaluate, we talk to everybody. Part of our diligence is really picking up the phone. Hey, what do you think of this market? What do you know about this building? What have you heard about this? Have you leased it before? What are the current tenants saying? What is the market saying? What is the economic development parties for those communities saying? So each community has an economic development party. And usually they're part of either the governing body. And if you talk to them, hey, what do you know of this building? I wouldn't buy it with a 10-foot pole. Okay, thank you. Those are the things you really want to dig into. So diligence is important. Doing your homework is important. Really peeling that onion and listening. And we do a lot of that.
How do you syndicate a deal on a vacant building?
Well, that's a great question, Ash. So the ultimate is in a vacant building, on a syndication on a vacant building, it's a value proposition, right? You're saying to somebody, in the future, we will have this, which will, in theory, or hopefully in theory, be better than a double, right? So if I were to pro forma buy building in our buy box, that might be let's call it a 9% cash on cash return with a 20% increase or 8% increase off that each year, right? Based on rent increases and efficiencies. In the vacancy space, when you syndicate a vacant building, you're telling people we have no cash flow. We have a plan. Here's our business plan. And here's how we're going to execute that business plan. And that's what they're investing in. And so the appetite for people to make those investments is totally different. We have some people that'll look at our syndication for a vacant building and just say, no, like that's not for me. And they do it graciously and respectfully. The other people are saying, wow, I want to learn more because when you fill this building, what does my cap rate or IRR look like? And you could take an IRR model that would say, on a current building, you might be at a 19 to 21% IRR, right? Let's say that. In the vacant space, there's good theory that you could be 8 points ahead of that or 8 to 10 points ahead of that. Let's just say 27 to 32. But you have a lot of assumptions that are in there, right? You're taking a lot more risk, a lot more opportunity. And there are people that have that appetite. And so we syndicate with the business plan. You syndicate off of what your execution plan is. Then ultimately the ending IRR or the ending return is what really is the final hook for people. It's almost the same concept, Ash, as how do you syndicate a multifamily building that you're building, right? Well, you're building a vacant building that you're going to lease to somebody over a period of 24 months. It's a very similar concept that we get buy-in from those investors.
Yeah, it makes a lot of sense. Do you find it's a really tough sell, or do you have enough investors that are savvy and they know what they're getting into?
Yeah, I would say to you today, without any arrogance, we've delivered on vacant buildings to our investor base, and it is easier than I would have anticipated it being, but it still requires tremendous diligence and opportunity to meet new people because your database always has to be growing to find those people that want to participate with what you're doing.
And what are you doing to gain this incredible database of investors? Okay,
so here's what we're doing. Our playbook's very simple. Our playbook is a 506C playbook. So what people don't understand when I say 506C is the SEC has different distinctions to how you can raise money through what is their Form D, right? So Reg D allows to determine how you raise money. We used to raise money here when it was a 506B, which was known parties and had limits of 2,000 people on outreach, and you were limited, okay? We've pivoted to a 506C, which allows for general solicitation. Now, the biggest factor that has changed in that whole space is how the SEC evaluates what is called an accredited investor. You, the investor, used to be able to raise your hand and say, I'm an accredited investor, and I can sign my name telling you that I'm that. Under the 506C, there was a litmus test that had to be done by a third party. Parallel Markets, my accreditation. There's a lot of different third parties that would do an accreditation that was not us, but it was a third party that would say, and they would give us an accreditation letter that would say Mr. Smith or Mrs. Smith is now accredited. And as a result of that, we can now have them be an investor. All of that has kind of changed, and there's a lot of ambiguity behind it. But under the 506C, there is a lot of rules on how people can become accredited. There's new ways to do it through experience, through self-accreditation. And that box still today is really not perfectly defined by the SEC because there's been a lot of litmus tests against it that have proven to be successful. So to answer the question, because that disclaimer was important. We spend a lot of money on social media and through Meta and through Google and through other platforms, curating messages and finding high net worth individuals who want to invest with us. Believe it or not, the world that we live in today in 2025, an investor will find me on the internet. He will see one of my ads, and the next day he'll wire us $1 million. Now, that didn't happen 10 years ago. That anomaly is hard for a lot of people to believe. If I told my grandfather, who's not with us today, but if I told him that this happened, he would never believe it. He couldn't believe it ever today. So the world has vastly changed to allow for investment, and it's great.
Scott, it's very interesting that you're saying this in second half of 2025, right? So a lot of investors, like you were saying, have had issues with syndications, especially in multifamily. They have a lower risk tolerance right now than perhaps they did 3 or 4 years ago. Yet you're out there killing it, bringing on new investors on a daily basis who are willing to wire $1 million for a higher risk vacant industrial asset. So what's working? What is the messaging? What are you doing so well?
So I'm going to tell you what's not working, Amanda, is the cowboys that got into our business that have defrauded or blown the trust of investors. And investors are generally timid. They gain or hook onto something. They make an investment generally out of trust and confidence that's either created or fabricated. And then hopefully you deliver, right? Unfortunately, our industry is riddled with bad actors, with unsophisticated cowboys that have really made my job so much more difficult because they have chosen short-term desires versus long-term sustainability, right? So what we have to do is we have to meet a lot more people. We have to talk to a lot more bodies. We have to build a trust and confidence mechanism that is way above what anyone would think. We do investor summits where investors are flown in at their own, at our expense, but at their own schedule to come meet me in my office. They have dinner with us. We get to meet them. We show them our projects. We walk them hard hat tours to our projects. We show them who we are. We do everything we can to create transparency, trust, and confidence. And ultimately, it's on the investor to do their diligence. The problem is when I travel, I get served up 50 ads right now from syndicators. And I know that 45 of them are not going to do the right thing. And that to me harms me because we're doing the right thing. We're nose down. We're grinding. We're making sure we're delivering. We're investor forward. We're only for the investor. We take our piece after they're fully made a whole. We are investor forward. And so when you do that, investors want to invest, right? They do. They just want to invest. They want to invest with us. They want to invest with stocks and bonds. They're dabbling with crypto. They're interested in the world, good or bad. They want to be investors, but the bad actors really make our lives really difficult. And there's a lot of them out there and we read about them every day. So our job's extra difficult, but we persevere. We add 20 to 30 new investors a month to our database. And when we add them, that doesn't mean they're investing. That means that they're qualified to be an investor. And some invest immediately. And some, we have an investor that just invested who's flying in tomorrow to meet me to hand me a $1 million check because he finally, after 4 years, is comfortable to invest with us. So it takes a full life cycle that starts from zero and can go as long as 10 years. And we're in it for the long game.
And by the way, half of those bad actors are capital raisers pretending to be syndicators, claiming this is my deal. It's all smoke and mirrors. They're literally raising for deals they know nothing about.
And we hope, Ash, that when you ask the first two questions, you can call that disingenuous actor out, right? And you can say, hey, I smell a rat, right? Because at the end of the day, we know they're bad. We know what they're doing to the community. We know that they have no moral compass, that they're ready to take money from somebody who earned $100,000. Imagine that. A person earned and saved $100,000 and they're willing to take it away from them in some bad act overnight versus us that want to put it in and build money trees for them for the next decade, right? It's like, it's just a cloth of the characters that are out there. And I encourage, what we encourage people to do, whether you invest with us, is make sure you check who your actors are. Make sure you understand who you're doing business with. Make sure you're measuring twice, asking that tough question. If your hair on the back of your neck goes up, there's a problem. So be mindful of what you're doing.
Yeah, Scott, the problem is we know what questions to ask. The novice retail investor, man, they just see these return numbers and they're like, yeah, you know what? I'm in. Right. They don't know what questions 100%. To ask. Right? They're not educated. That's a problem.
Right. And you take the SEC. So that's the other side of the problem that you can dig into for a minute. The SEC's accredited investor intention is to protect that novice investor, right? It's not that they're not liquid or not have enough liquidity. It's that they're novice. But that novice litmus test is not part of the accreditation process. What it is it's to protect someone who might lose their $100,000 and not be capable of ever recovering from it. That's still not a good solution, right? If you're an investor and you lose $100,000, it hurts. I don't care if you're worth a lot of money or if this is your first $100,000 you've invested, it still hurts and should not be permissible.
Yeah. You know what's interesting? When we had those high profile bad actors, especially the deal in Houston, a couple of the people that fled the country with millions of dollars of investor money, there was rumors that the SEC was going to raise the bar to be an accredited investor. I think they were going to double or triple the monetary amount. And now they're actually, it seems like, making it easier. They're talking about just having a test you can pass to consider yourself sophisticated or accredited.
Yeah, so there's a bunch of court cases and also rulings by the SEC. If you Google accredited investors, the process changes, right? So those bad actors harm a lot of people. If they raise the accredited investor threshold from 200 individual and 300 family to, let's say, double that, you're basically taking the opportunity for the ultra wealthy to just be the ultra wealthy and the middle class to never have a chance to become wealthy. That's all that happens. So they're protecting, right? But the protection does have a double-edged sword, right? It does protect against, but it also harms their ability to grow. So the SEC has looked at that. I think there's a lot of pressure today to loosen the accredited investor litmus test because people want to be investors. Now, if they circumvent that with some form of education and testing, great. If they make background checks available, the operators are available like they did at OFAC, right? You can go to OFAC and put in almost anyone's name and determine if they've been involved in any illegal operations that would cause a red flag. You should be able to do the same thing on the SEC website, right? Type in Scott Lurie's name and tell me what you come up with. You're going to find nothing. But if you put in the guys that ran away with the people's money or the guy in Washington, D.C. who put up concrete blockades and then put doors in front of them and called those units, those guys should be in prison. Those guys should be red flagged because those people harmed our potential investors. They harmed them. And there is no way to unring the bell because the money they spent is all on stuff, right? It's on instant gratification stuff, cars, jewelry, nightclubs, food, garbage, right? Garbage that cured that ego for 15 seconds.
Scott, I want to find more about your mindset. You're obviously a deal junkie, but I got to ask, if you saw a great deal on a single family house, have you graduated from that or would you still buy it?
No, I wish I'd stop. I still buy them. I still flip probably 5 houses a year just because they come around my little world and I can't say no because here's my mindset, Ash. On those houses, let's say I make 80 grand. Let's just pick a random number. I was going to say 100, but that sounds a little too arrogant. So let's say 80, okay? 80 grand times 5 deals sounds like 400,000. 400,000 can serve a lot of good in my ecosystem, whether it's to offset an expense, to do something, to operate in a certain way, to buy some more Bitcoin, to do something, right? It has a purpose. And so for that purpose, I just don't say no. You get hooked into this business, right? This business with discipline is the greatest business in the world. There is not a better business than real estate. There isn't, so long as you have a 26.2 mindset and you understand that you're going to have some lumps, but you do the right thing every single day. Don't ever not do the right thing. And as long as you do that, you've got a long history here. You've got a long career.
Scott, I am fascinated that you are still flipping houses every single year, building multifamily, having funds and syndications for value add industrial. You're doing everything. And are you also a private lender? Like, you literally do everything. And with the landscape of, it's the second half of 2025, deals are kind of hard to come by. People are coming off of a phase of lowering prices and a tough time for commercial real estate. If I'm a newer investor navigating the space, where should I focus?
I get, this is one of the questions that I get almost every time I have an opportunity or a platform to talk to people about real estate. Where do I get started? How do I get started? I don't know how to always tell people what direction to go. I don't know where your risk profiles are. I don't know what makes you tick. I don't know if you like mobile homes or if you are going to be on your family trip out to the Grand Canyon and you pull into this RV park and you meet Grandma Smith who's looking to sell the RV park and you're like, I'm going to shut her out because I don't even want to talk to Grandma Smith, instead of being like, oh, Grandma Smith, what are you talking about? You want me to buy this mobile home park? So this business real estate encompasses so much. It's so powerful. You could flip a single family home. You can be a duplex acquirer in A markets. You could be value add. You could be C market producers of low income housing. You could be light tech developers. You could get grants. There's so much to do. What I always tell people is do something. Whatever that something is, find your passion and find your way, and don't expect immediate results. Don't expect that you're going to lose 50 pounds overnight tomorrow. It doesn't work like that. That's not this business. This business is slow and steady. If you can make $200 of cash flow a door, that's a win. So people say, well, I only make $200. I know you made what you said you were going to make, the $200. Now you've got to put that on steroids. How do you do that? How can you find a high net worth individual to support your endeavors? How can you fix and flip? I have people that are buying flex industrial right now and they're painting the floors and doing the roofs and doing it all themselves. And then they're creating the value. There's so much to do. If you were to say to me, Scott, what should I do? I'd say go into the real estate industry. Find a place, find a widget, find a home in this space, and put your nose down and grind for 20 years. Not grind for 40 hours a week, grind 100 hours a week. Grind hard and grind with passion, educate and discipline. And then in 20 years, when you come up for air, you should have a pot of gold. And I don't know what that pot of gold is going to look like for everybody, but it should be something material that you should feel good about, and make sure you get started.
Damn, that should be on a t-shirt. I love that. Scott, what's your hold period for syndications?
Yes, you got all the good questions. Okay. So what do I write down? Let me tell you the story. We're a syndicator that kind of tells a story every time we put out a PPM. And I tell all of my investors this. Here's my hold period. 4 years, 5 years, 7 years. I always tell you this story. But then I say to them the following. But there is a high probability I'm not going to do that. And let me tell you why. If I can create enough value for you where I can return your money, 100% of your investment plus your preferred return within a period of, call it 60 months. Let's say I can do that. I'm going to refinance. I'm going to give you back 60% of your money. I'm going to then give you the free cash flow for the next duration of, call it 36 months, until all of your money is extinguished. Now, all of your money, you, Mr. Investor or Mrs. Investor, have 100% of your money back plus your preferred return. Why would you want me to sell this asset? Tell me a good reason. Because here's what's going to happen. Remember cost segregation? That's how I'm going to forward depreciate your money. So I forward depreciate your money D1, or when I build the building, I do a 179D. I'm going to give you everything you want. Depreciation. Now I'm going to give you all of your cash flow. Now you have all of your money back. The next thing I'm going to do, ready for it? I'm going to give you a big tax bill. And they're like, what? I'm like, well, we're going to sell the building. You're going to get all of this money. You're going to get all of your money. And then you're going to get a recapture of your depreciation. Once I recapture depreciation, you get to pay the government. And they're like, well, I don't want to do that. I'm like, either do I. So here's what we're going to do instead. We're going to just hold this asset and we're going to distribute cash out for the next 20 years. And when your kids get this asset, they're going to say, Mom or Dad or Grandma or Uncle, thank you so much for this cash flow tree you gave me. We call them money trees. And so I always tell people, I'm going to do my best to get you your money back. And I'm going to do my best to get out in 4 years or 5 years. And I hate that Wall Street ever came up with this IRR model for real estate because it only works never. It really doesn't make sense to me. I don't
It's the
get
dumbest thing ever.
I don't really get it. I get it. I can do the math. I can tell you how the equation gets to. I can tell you also where you're going to get your tax bill. You're going to be pissed off. Or I can tell you that I'm going to give you generational wealth. I'm going to then in 20 years, maybe we lever it in 20 years to a 30% leverage because we paid it off. I'm going to give you tax-free money forever. And your portfolio that you invested 100 grand with me is now worth $1 million. Would you be happier with that? Or would you happy with a $70,000 tax bill? Tell me right now.
Okay.
And they always say, what?
Here's the problem with that. Prior to rates going up, everybody had 3 to 5 year holds.
For sure.
Now we've got some, I'm going to call them shady actors that coined the term generational fund, the legacy fund. And a lot of multifamily people especially are going to 10-year holds. And it's not because they found a better way. It's because their deals, not yours, their deals don't pencil out in 5 years like they used to. They're buying on razor thin margins. They're overpaying. And I think people are skeptical. And, the question that I ask investors is, hey, would you give your stockbroker money and say, cool, I'll see you in 10 years? Isn't that a tough sell? The way you phrase it.
But here's what you have to remember. The difference between me and the generational overzealous pro former that doesn't know what they're doing is I'm giving you back 100% of your money first. You get your money back. You have that 100 grand. Let's say you invested it with me. By the time that I'm selling the asset, you have it back with you. You get every dollar. You have an 8% preferred return. You have that too. These other people, the reason that they're pushing this out into a 10-year hold that will ultimately be a 20-year hold is because they can't catch up when you're performing a 4% interest rate and you're stuck with a 6% interest rate on $40 million of debt. You're doing this, dog paddling to the shore, almost hoping you're dead because you can't make it. We can make it. I can sell the asset. I can do every single thing my pro forma says I'm going to do. I can do that. I just tell people, why do you want me to do that? Because if you want me to, I'll do it. And I'll show you the 212 equity multiplier and the 21 IRR. I'll show it to you. It'll be coming your way via check tomorrow morning. And then you're going to get your K1 and then you're going to be pissed off.
Okay. So let's say you have 40 investors in one deal. 10 want their money. They'll pay the tax bill. The other 30 don't. Is there a liquidity event that you can get the 10 out? Or do you ultimately just make a decision like, guys, this is a great deal. We're keeping it.
Yep. I'm the managing member of all of our syndications. They've invested because ultimately they've placed their trust with Scott. They've placed their trust with F Street. They've placed their trust with my team. And they've asked me to be their custodian. They've asked me to be their representative for their $100,000 or their $1 million. And so I take that with the utmost grace and also determination to do what's best for them. It's not what's for me. It's for them, the investor. And I always do that every single time. And so the answer to your question is, of course, there is no liquidity event in syndications. We tell them that right away. If you want your money today, do not invest. I tell them if you're not ready because you're not going to sleep tonight, do not invest. There is no hard sell. There is the opposite. If you're not ready, I want you to wait until you're ready. But when you're ready, you become illiquid. These investments are long-term investments. We want you to be smart investors. And I promise you, you will be happy, but I can't interject from the time you take your money to the time the cycle ends, call it 5 years. Your happiness could change because your family might need money, your kids might need money, a life event might occur. And this investment doesn't have that opportunity.
Scott, that all makes sense, except at the point of a refinance, why would you not give some investors the option if they want to take their pop, right? They want to take their 20% IRR and go reinvest in another 20% IRR opportunity versus keeping that equity forever. Do you not give them that opportunity at a refinance?
Yeah, you could. So it gets a little bit more complicated, Amanda. You absolutely probably could take what would be the refinance proceeds you could offer to buy out the equity of those parties that wanted to ultimately exit at a return. All of that can happen.
Exactly.
I've been very fortunate that I've never been pushed by the investor to do that, right? The investor has bestowed trust with me. They've given me that unbelievable sense of privilege that I get for them when they offer their investment to me, and I do what's right for them. I fortunately have not had that scenario happen in the period of time I've been investing where 10 people are like, hey, I want out. I have had one or twosies that are like, hey, I have a life event or I'd like to get out, but I haven't had anything material where someone's like, get me out of this right now. And we don't have that type of investor group. We have a very, as I said, we bring all of our investors together for an annual summit. We bring them to Milwaukee. We spend time with them. We're open book, transparent. We want your investors, I don't even know who they all are, to sit next to each other and ask about their experiences with me and what we've done and have they received their payments and how's the private credit fund and how's their experience here, and walk through and kick the doors of their investment over here. And they all end up deferring to me, which I'm tremendously grateful for. And I have not been pushed, Amanda, to that, but that's certainly an option. It's a well-conceived option that's available.
Ash, I want to hear from you too, because you said IRR is bullshit, but you like to push returns and get out quick and then keep your money moving at high rates. Why are you saying IRR is bullshit? I'd love to hear.
It's the way the formula is. That's why these apartment deals look way better than they really are. I always use cash on cash returns.
So do we.
Got it. So you just don't like the timeline being into it, but you're good. You still want the max return constantly.
So we'll do total returns. IRR, listen, if you do a refi early for some portion of money, that IRR number goes through the roof.
Right.
Even though the deal could be shit on the back end, right?
Well, that's all just about IRR model is really a time sensitive model, right? So if you get paid money back today and then you get the next check the next day, like it, as Ash said, it really boosts up this IRR model versus what I think where I think he was saying, which I think you're spot on, is we always go, what's your cash on cash? As long as your cash on cash is, let's say 8.5 or 9.2 and goes up materially, people like to know, is your cash earning money? The answer is yes. How much? Here's the percentage.
Scott, we're going to take a quick break, and I want to come back and talk about setting up a fund and scaling. Scott, have you thought about setting up a fund versus individual syndications?
Yes. So we've looked at funds, we've looked at the fund model, and we ultimately have continued to look at the fund model. We haven't made a decision today as to what direction we're going for the fund model.